Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boisno. Today with Tracey King. How are you, Tracey?
Woo! Good. Happy to be here. Not
So
Kevin.
glad to
I'm the
see
new
you again.
Kevin for today.
What?
The new Kevin for today.
I know your hair looks great. His never looks that kempt. So neither does mine, just for the record.
Oh, well, this is freshly blow dried 10 minutes before we started because
I
I
feel
thought
so honored you would go to all that trouble. My goodness.
the wet dog look wouldn't work well for
Well,
today.
that's what you get from with me 99% of the time.
Ah,
Anyway, I don't even own a hair dryer, but that is probably too much information for most people. All right, moving right along. Just a few notes. Number one, we are part of the Crispin Commentary Group, and you can find our videos on our YouTube channel, Mortgage Pros 411 in YouTube, and then also on the Crispin Commentary website. Just in case you thought this week was all vacation, it's not, because tomorrow we have the release of the Fed minutes. The Fed is going to tell us in writing what we heard at the press conference after their last meeting. So sometimes there are new little tidbits in there, so we'll keep an eye on that. Thursday we have GDP, and then Friday we have PCE, the Fed's favorite measure of inflation. So who knows where we'll land on that. But in the meantime, we are in the green for a first time, it feels like, in a while. Maybe it's only been a few days, but the 10-year treasury is down to 10, God help us. Oh God, please never that. 4.44. It was almost 4.6 last week. So, I mean, that's better. That is better. Yeah,
better is good.
I know. Aren't you excited? I'm excited.
Better is better.
It is better. So I have swore that I don't care about rates, even though I do care about rates. But I am realistic about rates. So with all that being said, Fannie's newest estimate of where we'll end up with rates this year has been revised down to 6.1% from their mouth to God's ear. But I think it's interesting and important to note that we are not seeing anyone report that or even talk about rates in the fours, not even the fives right now. So if we can stay in this range of in the sixes, these are fairly normal rates. And I mean, historically speaking, of course. And I'm glad. I mean, I'm glad that people are getting used to this. I have
Yeah.
yet another client who is giving up 3 1/8, I think, on their first and buying a new place. I mean, it is happening. I've got a couple of them in escrow right now where they're giving up really, really low rates for having the house that they really need to have in a different location or whatever, right? Different rental property. So people are moving.
I think that you're right. And I think that the good thing about having this as a baseline is that it's become the baseline. It's stopped, the chatter even about rates isn't happening so much. And I think that trickles down to the borrowers as well. And it is kind of coming into people that have been looking and have potentially lost houses in the past, and they know that just this is where we are. Let's buy this house now. I think the conversation is more in a couple of years you can refi if rates go down, but it's not, the whole, okay, give it 6 months, give it 9 months. We've all kind of settled into this, and I think that it's settled down. And whether it's the borrower leading us or us leading the borrower, I think the energy has changed a little bit, or there's a bit more of a kind of coming to terms with where we are. And so it helps you be a little bit more calm about it and reasonable of what the options are.
It really is. And I think it's much healthier this way.
Yeah.
I am really clear with my clients because we're doing 30-year fixed loans. There isn't enough of a benefit for them typically to do an arm. So we're doing 30-year fixed. And I tell them, I'm like, if you can refinance later, great.
Yeah.
But if you can't, you're fine. And so I don't make promises. I'm not, looking in the future and counting on that. It may happen, but I think that this cycle that we've gotten into as an industry is very unhealthy. I've talked about it before, and I feel like we need to embrace this, which we didn't used to have refi booms. I mean,
Mm.
I remember the first time we had one and we were all so excited. It was great. But the industry has really positioned itself where the models are for a boom and a bust. And for anyone who is dreaming of really low rates again, I would just like to remind you of the last 2.5 freaking years where we have been nursing a hangover from the previous, time where, by the way, everyone was complaining constantly about how tired they were and they needed a break and, "Oh my god, I can't handle this." And I just wanted to remind them gently and politely, using my nicest words, that we go in cycles. This is how our industry is. This is what normal looks like for us. And so we need to, whatever our focus needs to be on purchases, we need to focus on helping people who are looking to buy and sell. And then if we can catch the refis, great. That's awesome. And right now, with all the debt out there, which we'll get to, I mean, it's a great opportunity for that. So
Yeah.
I don't know. Maybe every mortgage company doesn't need to go IPO. Maybe not every, IMB owner needs a private jet. Maybe not everyone needs to live in a 60,000 square foot house that they built on using mortgage profits. I don't know. That's just my thought. What do you think?
I'm right there with you, and we've both been in the industry quite a long time and seen the ebbs and flows that it goes through. For myself and looking at a lot of our customers, the ones that make it through are the mid-sized community banks because well, I shouldn't say make it through. I should say have less of a swing in the way that they operate. So the other thing is when you have these booms, you have to hurry up and hire, and then we feel that ripple effect for years. So I think there's still companies that are trying to resize for where they are now because they've been hopeful that it's still going to swing back, still going to swing back. And, they've been having to make a lot of cuts. The companies that are still doing well and did well were the ones that kind of held on to their numbers and their head count, I think, as long as they could and only slowly added to it and maybe didn't have the upswing that some others did, but also the fallback wasn't as sharp and severe as well. So I'm in agreement, and we'll go back to our common friend, Mr. Chrisman, who throughout the years, and I think we've both seen on stage many times when people would say, "What's coming?" And his biggest thing is nobody knows. And if they do say that they know, you need to kind of look at that. I wish I had a website where we could track what everybody's proclaiming is coming and then on that date say, yeah, it didn't happen. Because like he said, it's a 50-50. You can flip the coin and they're either right or wrong. But I think for so long people have been waiting and waiting and waiting. And to me, that's not a way you can operate a business, is you have to, why are we trying to build our business to what could potentially come? Now we hope, and we want to be able to support it, but you also have to do it on like, what's our baseline? And like we just said, it's like the last 2 years, here we are. This is where we should kind of be modeling things with the hope of growth, obviously, always, but not as a hope of like it's going to pull us out of something. Like we should be able to maintain operations as we are without looking for that savior down the road.
It's funny. We had Dr. Lawrence Yoon, who is the chief economist for NAR, on last week, and I got somebody called me afterwards like, "Oh my God, you are the first one to ever get an economist to say that they were wrong about something." And I said, I don't feel like I made him disclose that. He
Mhm.
apparently was number 5 most accurate economist out of like 120 or 150, like a lot of, I mean, like he's
Yeah,
definitely in the upper echelon. And I appreciated the fact that he acknowledged that, okay, there was a miss on something. And
right,
but the reality is, I think it's unfair to expect somebody to forecast into the future with the kind of variables that hit our business through debt ceiling crisis, a war, an invasion of another country, a bank crisis, like the list goes on and on and on. It's just incredible tariffs that come out of nowhere. You just
right.
don't know what's coming next. And to think you do is a fool's errand, I think. So again, we've been doing this for more than 5 years, 51 weeks a year, and I have realized Rob Chrisman is correct. Don't try and forecast the future. It's ridiculous. And all we can do is make sure that we as LOs are really clear about what is happening in the interest industry for real, the headlines, which ones are correct, which ones are incorrect, so that when we are talking to our referral partners and our customers, our clients, then we are able to say to them, okay, I know you just read this as a headline, but this is what's really going on. Or
Right.
drill down to your community, your market, because a lot of the things that we see are national, et cetera. So, or and boy, I'll tell you, the more you talk to reporters, God bless them, and we have a few who listen to the show. I mean, they're just trying to find information. They're not industry experts necessarily. And
Right.
so, and a lot of times you'll see that the article is correct that they wrote, and then the headline is crazy. And so, and I've asked about this, and they're like, well, it's the editors.
I was about to say it's usually not the reporter that does it. Yeah.
It's not. So we have to give them some grace too, because again, they're not the, people looking for the salacious headline that is going to catch somebody's attention and make them click. So with all that being said, as lenders, our job is to help our borrowers navigate all this. And the more we can stay just calm, cool, and collected, the better off we are. Which reminds me of something that happened the other day. So I have a client who, again, is giving up, I think, 3 1/8 on her investment property. That's her rate on her investment. She is selling that and buying another investment property for some personal family reasons. And and like going from 3 1/8 to 7% without blinking an eye, just to be clear. So she's doing a 1031 exchange, and I am not doing the loan for her buyer of the house.
Okay.
Somebody else is doing that loan. So it was through just happenstance. I end up on the phone the other day with escrow because I was trying to get some idea of how much the proceeds were, right? And through that conversation, she throws me a number. I'm like, that doesn't sound right. It's too much. What about, I mean, are you calculating the payoff of her first mortgage in there? And she goes, what mortgage? The preliminary title report did not show a lien on it. So they were about to close this loan and wire $1.3 million in proceeds to the 1031 exchange company and not pay off the mortgage because they didn't know it existed. So,
Oh,
yeah. So number one, it's she was gasping for air. She was so freaked out. She's like, oh my God, thank you, thank you, thank you. And I'm like, yeah, but it's just the reason I'm talking about this is it's another way for us to be valuable is if we are
right.
actually, noticing things and paying attention, then we can be valuable. So not only does the escrow officer think that, I am something special, but so does the buyer. But I was so calm when I called the buyer. I said, hey, just wanted to give you a heads up. You're going to get a couple forms from escrow, just acknowledging this, and they're going to order this demand. And, we should have it by Tuesday and blah, blah, blah. Anyway, so I stayed calm. It's no big deal. But thank God we did this because you know what they would have done? $10 says that escrow company would have been like, well, the borrower didn't tell us they had a lien.
Right.
Okay, the buyer doesn't really always know or pay attention or right. So just something to think about because I'm like, oh
Yeah.
my God, this could have been such a shit show. That's a technical mortgage term. I'm sure you're familiar with it.
Yes. I very, very, but I think it's a really great lesson. And you've said like a few words that are sticking in my head as you're going through all this of like variable, control, slowing it down. And, there were, I don't even call it a generation, but the COVID joiners of the mortgage industry where things were just flying and it was very like we can just churn it through and things weren't necessarily messy and it was kind of we'll deal with it later mentality to where we are now and the value that it provides, as you said, not only your peers, but also to the borrower. That makes a difference. They will remember that.
Yep.
And, throughout everything that we're talking about, to kind of slow down and remember the value of what you're doing, and what that means to the borrower, and that the primary goal for us is to get them into the house, but also to educate them. And I
Yep.
think that that education piece always gets kind of pushed to the side because we just wanted to close the deal and make it happen and make sure they stayed with us rather than somebody else. And we forget to slow it down, talk through it, make sure we're, doing all dotting the I's, crossing the T's, doing all the things that make sure that the loan goes through, but also makes you a differentiator.
I agree 100%. And my generation, you can speak for yours because you're younger than me. I mean,
Barely.
you were really taught to, like, you were never supposed to draw attention to yourself. You were not supposed to beat your own drum. You were supposed to be modest at all times. You were supposed, and in the mortgage industry, when I started 10,000 years ago, it was really all about getting the job done and never letting anyone know how hard it was. We solved problems and had miracles happen all the time, and we just kept it to ourselves because you didn't want to freak anyone out and you didn't want them to worry and you didn't want it to seem like anything was ever wrong. And that is where how we got to the mentality where, hey, dude, I could just push a button, make this happen. What do I need you for?
Right.
So, with all that being said, in a way that is not beating on your chest and, sounding like an egomaniac, you do have to share those situations with your borrowers so they understand your value. Other ways they think they can do it without you or with some schmo down the street who offers them, you know, half of an eighth less. What is that? 16th, I guess. Okay. Anyway, we don't go to 16th. I
Well,
make
and at some point it is going to be a push of the button with the way AI is moving. And having us, and they talk about but I've, heard so many things about our industry being, it's driven by technology until the borrower wants a human. And then it's like a hard stop. It's like they want everything just this digital process until they don't. And we
right.
need to make sure that you're highlighting when they don't, and that there's a human behind this, and that you're guiding them through all of it.
I just find, and I think it's how I've positioned my business in the last few years, which is vast. It's so different than I
Yeah.
did for the first few decades. I really am focused on things that are not so easy to fix with a push of a button. My focus is really can't, I mean, I had to call an investor today to talk about two private money loans that I have people making offers today, and they need this interim financing until one is a fix and flip and one of them is a bridge loan. And, like just running the scenario by him, it is so, so important to have embraced and to embrace these different programs that exist that are so great. But again, like somebody who just got into the industry because the rates were low and they can make a lot of money, they
I,
are never ever going to be able to do what I did the other day on the phone with escrow because they wouldn't know what they're looking for. They wouldn't know they wouldn't know anything. The math wouldn't click in their head. I mean, that experience actually counts for something. And I mean, if we took the average age of the people, in the mortgage industry right now, we know it is not low. And we have a lot of experience and that's valuable. And we want to be sharing this with the people who are coming up
yeah.
and help them understand that we can use the technology, but it really does require a mix of humans who know the other humans and how it all fits together. So I feel like we can't emphasize this enough. It's so important that we embrace all this because we have a situation like right now. So let's talk about debt in the US. Now, I got this from our friends at MBS Highway. Debt in the US, mortgages are $13 trillion, autos are $1.6 trillion, student loans are $1.6 trillion, and credit cards are $1.2 trillion. Credit card debt, that doesn't include buy now, pay later, by the way. So credit card balances, I remember we were all gasping when it hit $1 trillion in credit card debt, and I feel like it was like last year. It was
Yeah, it
that
wasn't
long
long
ago.
ago.
It's going up pretty exponentially. The student loan debt, I mean, that $1.6 trillion, that's a ginormous number. And a lot of those people are in default. I mean, we've talked about the numbers pretty regularly recently, and they have to start paying on them now. So it's so, so important that we're able to go into somebody, like look at somebody's credit profile and figure out, all right, now what? Like, does it make sense?
Yeah.
Yes, I know you have 3.5%, but, and maybe it makes sense to do a HELOC, but maybe it doesn't. And so it's going to take somebody who can talk to a borrower, actually have a conversation. Those conversations are valuable. And how do we deal with your debt?
Have you heard of, and I swear this is not an endorsement, and have you ever heard of Loan Sense?
No.
So there's a woman who started a company, and I'm going to botch this, but one of the things she's looking at is student loan debt, and she's doing it with credit. And so she's adding in this to like the part of the the loan process is how can we also, in addition to working with you on the mortgage, but let's look at this student loan debt that you have. Because that's another thing is that so many borrowers are lost on understanding what they're doing with their student loans, and it's all over the place. So they're working to like resolve reporting issues. So they're working with different loan officers and companies to try to figure out how to provide this additional support. I don't know if any of your listeners have heard of this company, but it's something that's perked my interest recently, especially with everything going on with student loans in the last few months. And I'm curious, it might be something worth looking into to differentiate yourself as well. So I was curious if you'd heard of it or worked with anyone like that.
No, not at all. But I
Okay.
think it is going to become more and more important. We're all going to have to learn how to figure that out. And my concern is that this group of people who have all these student loans are just going to say, you know what? I can't handle it. So what? Screw my credit and just throw their hands up in the air and figure they're going to be renters the rest of their life. Although I don't know
Right.
how you rent a house anymore without having good credit, but that's a whole nother thing.
Yep.
So again, how can we be a resource? And I really believe that we need to go backwards in time and embrace purchase first. Everything else is secondary. And you have a very consistent plan that you work so that you are offering, you're letting it's an outreach. It's no longer raining from the sky.
Yeah.
So very, very important. All right, so we got March home price appreciation in with Case Shiller showing that appreciation was up 3.4% year over year. And FHFA, say that three times fast, was up 3.7% year over year. So again, appreciation levels they're hanging in there. They've moderated for sure, which thank God. And so we'll see what happens. I mean, I am hearing from certain states, I'm hearing AEs talk about appraisals coming in low. I don't know if anyone's seen that. I'm knocking on wood. I haven't yet. So it and what I'm seeing in purchases is if you price your property correctly, you're getting at least one offer, sometimes multiple offers. But I have some borrowers who are putting an offer on a place this morning and they saw this property 2 months ago and assumed it would be gone. It's still there. And then the buyer's agent who I'm working with, he told me that the listing agent is only taking offers Monday through Friday from 9 to 5. I'm like, "What?" Like,
Whoa,
like, what the
that's something.
I'm like, "God, I wonder if that has anything to do with why it's still on the market." You know? And then I had another one where they put an offer in and the list price was, I don't know, like 900 maybe, and they were gonna offer the list price and the listing agent was like, "Nope, we want 1.2." I'm like, "Um, do you know what market we're in now? That's not how this rolls, right?" So you've got some really stupid things happening out there as far as prices and real estate. So if you've got a place that's sitting, there's probably a good reason for it.
Wow.
Isn't that nuts?
That's obviously that realtor told that borrower to list it there because they would get it up to, that it would create a fighting war that never happened.
Yeah, exactly. So again, we need trained professionals on both sides of the equation. So the realtors have to go back to school and learn how to negotiate, whether they knew it before and forgot, or they never had to learn it because all they had to do was stick a sign in the front yard and poof, it was gone. And that is, again, we're professionals. That's what we're supposed to be doing. So I thought that was very interesting, right?
I have a question for you, Audrey, because you have talked about how you've pivoted within the last few years
Yep.
completely, and that you've just your model of doing business is different yourself.
Yep.
And I believe the driving force was you needed to in order to kind of be as successful as you had in the past, and you recognize that. But what how do you think, or what were the best tools you had to get there, to understand what, to learn about all these products, to get out there and be able, is that something that everyone could easily do, or do you have advice for people of where to start? Or I'm just interested in that.
Yeah, so I mean, I have reps who will still say to me, "Oh my God, I remember when all you ever did was a paper." And I'm like, "Yep." I mean, I can't deny it. And it's almost embarrassing because again, we've been doing the show for 5.5, not quite a half years. And so I'm exposed. I became a student of the industry. Like I am
Mm.
constantly listening to things that probably have nothing to do with me. I'm always trying to learn new things. So, and I teach in MLS, right? The continuing ed.
Right.
So I've got my ear to the ground all the time. So it took me a while, longer than it probably should have, to go, huh, I keep telling everyone else to do this. Maybe I should. So,
That's the story of life. It's always easiest to
oh my
give
God.
advice than to
So
take our
dumb.
own. Yeah.
So anyway, but oh my God, thank God. And there's still this perception. We still have people who don't do non-QM. They think it's subprime. It's not. My borrowers who I'm doing private money loans for, most of them, not every
Right.
single one, but most of them have 750 plus credit scores.
Yeah.
Most of them have tons of equity and like they're really in good shape financially. Most of them. The non-QM loans I'm doing, oh my God, can I just tell you how freaking happy I am that when I have a borrower goes in a contract and then, before I have an application or I run a credit report, and then I figure out that we can't qualify them Fannie Freddie, I'm so grateful for DSCR loans. I mean, I can just flip them and they're done. So
Wow.
it is not hard. I mean, we've done a zillion different shows on this and we will continue to do that. I keep talking about all the different options and they're so important. But I'm a big fan of be a student.
Yeah.
Always be curious. I'm super curious, like to the point of obnoxious, probably a lot of times. I ask way more questions than a lot of people want to answer. And I'm very detailed. So get really curious about what else is out there. How can you help your borrowers and do not have a blockhead mindset where there's one way, this is the way we've always done it. Get out of that. And and again, your experience is going to be your best weapon because it really does help you stand out from the crowd because there's a lot of ding dongs out there. Another technical mortgage term there for you,
Yeah. Yeah.
like
Well,
that.
that's great. And I bet in some ways it's probably more challenging, but more interesting.
Oh my God, I love
Yeah.
it. I love
Yeah.
it. And by the way, I mean, like, okay, so my borrowers are not, like if somebody comes to me and goes, and their first question is, what is the rate? I'm like, see ya. I don't want to have that conversation. Go talk to, one of the big boys and see if the 30 to 40% of what gets thrown against the wall that funds, see if you're in that bunch. Otherwise, like understand that I'm a professional. I bring something to the table you're not going to get anywhere else. Well, maybe with some of our listeners because they're also good. So the average person doesn't want to really work that hard. And I love things that I feel so
Yeah.
satisfied when I figure out a puzzle that is my client's life, right? So
Hmm. That's
um
exciting.
I know it is. Okay, so one thing, here's something that could potentially do something to our rates, not in a great way. They did actually vote to raise the debt ceiling by $4 trillion. So they didn't wait to the last minute. So they get some kudos for not taking it all the way down to the deadline where, okay, at midnight, Friday night, the government
Mhm.
shutting down. So we're not going to have that. But the bad news is they're going to sell government bonds and we're going to have to absorb that into the system, which sometimes can take away from buying MBS and rates can go up. Our debt is currently at $36.2 trillion, which that's why Moody's downgraded us because the debt, there's concern about the debt. And so it'll be very interesting to see maybe all the Doge things and the tariffs. Maybe that is that going to help fix everything? All right, we'll see.
We'll see.
Okay,
I
so
can't predict. This is, above my pay grade. And
I know.
all of those things where it's just, I mean, I just read something today where it's like, no one can really make sense of a lot of things that are going on right now
Yeah,
with the markets. It's so wonky because of all these moving parts that it's difficult to put a pin on what's going to work and what's not.
we talked about that with Dr. Yoon last week about how, typically if the stock market is selling off, that money goes into bonds and the rates go down. That's not happening right now. And conversely, the same thing happens. And it is very, very hard to figure out which way we're going. Okay, so we had existing home sales for the month of April. That is, sales that went into contract in April for homes that were already built, not new homes. Good God, why am I winding through that in such a ridiculous way? Okay, so those were down 5/10 month over month and 2% year over year. Annualized pace of 4 million units, which is about what I think they were forecasting. We'll see how we end up. It was the slowest April since 2009. So, are you guys seeing that in your businesses as far as purchases? And are you seeing things tick up a little bit in May? Because certainly I feel like I'm getting a lot more phone calls this month than I did last month. Median home price $414,000, which is up 2.7% month over month and up 1.8% year over year. So inventory is interesting right now. So for the last few years, we've been screaming, we need more inventory, need more inventory, we don't have enough. And then once we start having those levels go up, then people are freaked out and saying, "Oh my God, oh my God, oh my God, inventory levels are too high." You know what I mean? Like there's no one's ever happy with where we are, right? So we are at 1.45 million units. That's up 9/10 month over month and 21% year over year. So it's also interesting to note that a lot of that inventory rise is very concentrated in a few states.
I was
Um,
wondering that.
yeah,
Yeah.
so, it's a 4.4 month supply. Normal month supply is 4.6 months. And so we are definitely getting a little closer to normal at the nationally, right? So you'll have to check your markets, whether you're in Florida, that could be very different. I'm hearing some wild stories out of Austin, as far as prices, like appraisals coming in low, Florida appraisals coming in low. So
Mm.
you might want to really be paying attention ahead of time to, you know, what are we looking at as far as value goes? And again, this requires doing some homework, maybe getting some help with the realtors pulling comps. Again, you can't tell an appraiser how much you want the place to appraise for, but somebody could provide comps to an AMC and say, okay, this property, this is more comparable, and this is why, and even though this sold for a lower number, that's why this one wouldn't be as comparable, et cetera, et cetera. So again, you do have the ability to be proactive on a lot of this and really help your buyers and sellers. Okay, so sold above list price is at 18%. 18% of listings are selling above list. That's down from 27% last year. First time home buyer,
Oh,
34% of the market, down from 33% or up from 33% last year. So just slightly more first time home buyers. Cash buyers are 25% of the market. So that's 28%. It was 28% last year. And investors are 15% of the market, and it was 16% last year. So not a huge amount of change as far as the mix of buyers. And so again, I thought it was interesting a few months ago because we had heard millennials for so long, and they are buying houses again. But the like the 62-year-old woman is like the biggest number of buyers or the average buyer. It was some crazy thing like
oh,
that.
really?
Yeah. So anyway, I thought that was funny. Um, okay. So we have some comments. So someone said, you said a week ago or so ago about a Fannie program that allows you to do a cash out, refinance, and pay off student loans with no LLPAs. I don't know that it has a special name, but if you call your lenders, they should know about this. So again, there were a few requirements. They weren't anything extraordinary other than it has to be student loans. They have to be your student loans, or you have to be on the student loan, et cetera, et cetera. So I would just check that out with your lenders that you use because it's just a Fannie program. I don't think it's anything terribly special. Isn't that something though? You can do a cash out refinance, but not pay the cash out hits and to the pricing, which are redonkulous. And so there you go.
Oh, Jill James. All my current buyers and clients are women 55 plus and self-employed. Wow.
Yeah, isn't that something? I mean, yeah. Um, okay, so Guy had made the comment of when we were talking about, just using buttons to get a loan. He said he had a little trouble typing. Anyway, he said that E-Loan tried that many years ago. Remember E-Loan?
Yeah,
They thought they were super cool. Do they exist anymore?
I don't think so.
Yeah. Um, so Tony says dumb offers can sometimes be a great start to a conversation that lets buyers and sellers sell. Um, Okay, and then Ellen said Oakland, Berkeley area always price to entice. Homes go 20% and more over list price. Okay, so funny she says that because the property I'm talking about is in Alameda, which is Oakland, Berkeley adjacent, and kind of have the same thing. And guess what, kids? Market is shifting. So let's see if my buyers get into contract today at list price. I'll let you know. And I have somebody else that is buying in Alameda, which again, it's a just so you it's a ferry ride across the bay from San Francisco. So a lot of people really love it. It's just kind of this little enclave, and there you go. Anyway, so here's the question: as we are in, what are we? Can you believe we are? I mean, we are almost
No.
June. We're almost halfway through. I mean, it's redonkulous. Oh my God, I can't say that anymore. Next time I say that word, will you please smack me? Because I'm annoying
Well, they say
myself.
as you get older, time goes faster, and I'm like, yeah, it is wild. And I don't know if that's just that I'm just older now, and so yeah, every year is flying. But the fact that it's about to be June
I know.
makes no sense to me.
Easy, crazy, crazy. Um, Totality, which used to be CoreLogic, as we know, we stopped making fun of their name because we're getting used to it. They came out with their rent index for single families for March, and they were up 2.9% year over year. That's for blended new and renewal rents. This is quite a bit lower than what is showing in our inflation numbers. So it'll be interesting to see that the inflation numbers they've gotten a little bit better as far as reflecting something a little closer to what is reality in the market. But those inflation numbers are always like the rents in the inflation numbers are always way higher than they should be. I can never figure out where on earth they're coming from. It drives me crazy. Crazy. Okay,
Insane.
listen to this. So, did you hear that? Do you Palm Springs? You've heard of Palm Springs?
I've been to Palm Springs.
Oh, geez. Okay. Well, guess what? Some bozo brain bombed a fertility clinic last week or the week before, I don't know, recently, right? So I have a friend who owns a business there, and there were dozens and dozens of businesses that had their windows blown out by said explosion. And guess what? Uh, the insurance companies don't cover it because it was, and I quote, an act of terrorism. So isn't that interesting? As I
Wow.
mean, can you imagine owning a business and all of a sudden, yeah, so that happened. And I thought, God, it just makes me think about things like if you own a rental property, if you own, like, at what point you got to know what is in your insurance policy. That's my point here. I actually had a point, believe it or not.
Yeah.
Um, and so you need to be helping your clients remember to review with whomever they need to review with. Their insurance agent probably be a good idea. Their insurance policy so they know what on earth is covered, what isn't covered. It's a great, so when you're doing your annual mortgage reviews with your clients, which I'm sure everyone is doing, right? Then this is something to bring up to, and maybe team up with the insurance agents also to make sure that's happening.
Who knew?
I know. Okay, so lest you think the Financial CFPB, Consumer Financial Protection Bureau. So I think I mentioned this before, the director that was supposed to be the director has now been pulled and is going to be doing something else. And now we don't know what in the heck is happening. But
Shocking.
they just released their annual report for 2024. It is 96 pages. Don't worry, kids. I'll read it for you. I'll give you a summary next week. It'll be way less than 96 pages, but they're still doing something over there. I mean, someone's doing that. I'm going to find out who, but isn't that interesting?
Yeah. I want to know who's left,
Right?
what the positions are, what they've been limited to, who's driving that train.
That's a great question. I have no idea. I'll see if I can do some poking and find out. It is and also I'm really close to having the California regulator, the DFPI on, and they are in touch with a lot of the regulators across the country. So in California, we have two. We have the DRE and the DFPI. So, and they
Okay.
talk to each other, and that, I want to get some idea of like, what are they doing? Because it impacts all of us. So
Right.
again, okay, this kind of made me a little crazy. So Freddie Mac came out with their profits. Their
How many
income
points?
dropped, but their profits are almost the same. Can you believe that? So anyway, so they are making money hand over fist. Meanwhile, they're talking about whether or not they're gonna we get varying reports on whether they're going to come out of conservatorship. So again, talk about things that we don't know about. Stand by, because it may happen, it may not happen. Apparently the FHFA head Pulte told everyone
Yeah.
that he's working to reduce the cost at the GSEs. So nothing has been said about getting rid of the LOPAs, which in my opinion is like an atrocity, what the way that they have been charging everybody. But so yeah, there you go. Like,
Lots of changing tunes with that as well about the
let's talk
conservatorship.
about that, because we have for the last couple of years, I mean, what, almost 2 years, well, no, it was 2 years ago, we got the 411 that, oh my gosh, they're going to change the credit, like we're going to go from FICO to Vantage, we're going to go to three bureaus, from three bureaus to two bureaus, and all this crap, right? That this was all
Yeah.
going to happen for Fannie and Freddie, and then presumably for the FHA and VA as well. Um, is that all going
Yeah.
by the wayside?
Yeah, I mean, the biggest thing, at secondary, Pulte talked about moving to, the cost of credit, and then there was a drop in FICO's. I all I'll say is that he made an announcement saying that they're looking at how expensive the cost of a credit report is, and that a buy merge is the way to go. And then the bureaus responded with, we have all of our faith in the FHFA, but unless you tell us how that's going to protect the borrower, we believe the tri-merge is the way to go because there's a gap there. So it's the same argument time after time, where I almost feel like it's just kind of we're putting things out there and then reversing it just to kind of bide our time of looking at an issue where I haven't seen any progress in the last few years about it, other than just more conversations and people being confused and causing, when it first came out, everyone's like, what are we going to do about it? Let's have all these calls about it. I mean, we talked about it. And it's like freak out and then nothing. And then every once in a while, when people bring it up, we have our little sound bite that we can say of what we're doing to look at this. But then again, falls the issue of we can say a buy merge is the way to go. We have not said how this is going to protect the borrower to make sure that we're getting all the data that we need for them in order to price them right. It's still all of those gaps. So I hate being a broken record, but like nothing has changed as far as I know. And the big questions still have not been answered. And I don't know who's the person to answer it. It's just more of like, I think appeasing everybody that there's something going on, but we're just going to drag it out as long as possible.
But if the GSEs aren't talking about it and acting like it's any, I mean, remember we had the timeline, and then
Oh,
they went,
it still exists. They
oh,
still
that,
have yeah, they still have like their page that's gives the timeline. They update it. They just keep moving it back and moving it back. And we
it's,
are doing things on the back end to be able to to talk to Fannie and Freddie of how to support it once it happens. So like our tech team is doing things so that if and when it does happen, we can move towards it. But, the technology piece is one thing. The logistics of it are another. And until you put protections around you as the LO, the borrower, all of this, the GSEs even, how are we, the guardrails. I hate using it now because now it's everywhere, but you have to put those guardrails up. Otherwise, it's way too easy to manipulate the system. It's way too easy for a borrower to pull two bureaus with you, two bureaus with somebody else. And yeah, they got a different score, so they're priced better over there. How are we preventing that? Unless you actually eliminate a bureau, and good luck with that.
okay. So first of all, is it really manipulation when you're just using the information that is being provided to get the optimal outcome for yourself? Is that manipulation?
Well, it would be if you're being limited. So if you're saying you can only use these two, like moving forward, you can only use two. You're almost forced into a manipulation of like, well, I know that there's three. How do I get the best two? So right now there's not. It's like, what's the mid score? How do we go from there? If you put two without, thus far, there's no direction as to what that looks like, how they would be chosen, how they would be used, then you open yourself up to it because then it's, well, what's a hard pull? So is everyone going to pull a tri-merge pre-qual and then you see where the scores are? So then you pull a two bureau hard pull, then that's more expensive. You know, you're kind of being forced into ordering a soft pull tri-merge. So it's complex. And I don't know how it pulls or saves the borrower anything in the long term other than, yeah, it's going to create LOs kind of running around trying to figure out how to get the best outcome.
Okay. So I'm just going to take a wild guess and assume that that idea of having two was pulled out of someone's orifice. I won't say which one, but let's just
Yeah,
assume that's what happened, right?
yeah,
So,
yeah,
and the idea that you can't choose which ones or you can't figure out which ones, I mean, somebody made that up.
right.
Why? If they made it up, they can unmake it up because I don't know that it makes a whole hell of a lot of sense. And I mean, to what end? I mean, you have Credit Karma, you've got the Experian app, you've got all these apps anyway. So, like, can we just let that one go and like leave one piece of this mess, something that doesn't need to be enforced, nobody needs to be a watchdog over it, whatever. You've got, if you have three bureaus, let them pick whichever ones they want and don't, do we need guardrails around that really?
Well, I think the issue is that they're introducing a new score. So if you're going to have two different types of scoring models, FICO and Vantage, then do we need six scores for each of them? Well, let's reduce it. We only need, however more. But, if we really wanted to nitpick all of this, it's why do we need three bureaus? Where if you're looking at a credit report, now here this is my industry, this is where we make our money, but looking at scoring models, how we are scoring borrowers, that's something that probably should be looked at. And you and I talked earlier about pay as you go or buy now, pay later. All of these options of looking for a way to be able to kind of work with borrowers and save them money versus kind of looking at a cost of a credit report that's happening once in their lifetime versus tools to make them a healthier candidate and get
Right,
them to where their goal of where they need to be.
right,
That's a lot that I've heard come up more recently of we're talking about this, but we're not talking about the real issues for the borrower and where the borrower is underwater with that $1.3 trillion in debt.
right, exactly. I mean, the real question is, if we have three bureaus, which we do, that are all basically owned by the same entity, right? And we're
Mhm.
going to introduce a fourth Vantage, which is also owned by wasn't
Right,
it
the
the same
bureaus.
entity? Is that right? Okay.
There,
So
yeah.
now we have an organization that owns all now four instead of three agencies that we're going to somehow focus on. Honestly, make the criteria the same on every freaking one of them. So now we can change the three into one. That's one. And this Vantage thing, I have yet to have anyone show me. They
Yeah.
tell me, but show me how this is going to help people. And maybe it will. I'm not saying that I know the answer. I don't. I'm just saying I've seen zero evidence and I've asked for it of why we need this and why it's good, better, whatever, before we go increasing the cost to the borrower and creating another situation where it's like, messy and fuzzy and oh, you've got to have all these guardrails about I don't know. Why does it have to be so freaking complicated?
Yeah, I'm interested when Vantage came out, they had all these kind of pilots going on. I haven't heard boo about it in probably like a year. I'm wondering how that's going and if they're still ongoing. I'd be curious about that.
Well, if the team in India was running that, I'd say it's over.
Yeah, yeah, yeah.
Oh my God. I mean, who can keep track of all this, right?
No, I
Oh,
can't. That's
goodness.
why you're organized and good, and I just sit here and
What?
I said that's why we need you being organized and good, and I sit here and I smile and nod.
Yeah, you do a little more than that, thank God. So we have Tony commented, let's get great at what we do rather than changing things up. Useless change. Change to fix problems that we don't have means more expense that gets passed along to borrowers and buyers, which is 100% true. And by the way, then guess what they want to blame it all on? LO comp. Oh,
Right.
that's your problem. I see. well, I'm not making more than I used to, but that guy's driving around in a private jet. Can you tell I have a thing about this private jet thing? It
Yeah,
bugs me that these IMB owners are worth gazillions of dollars approximately. And and yet it's the LO comp that's the problem. Oh, okay. Got it. Got it. That totally makes sense, right?
right.
Oh,
Just
Tony's gonna
that.
blame it on me. Great. Of course you will. Of course you will. So, what else was happening at NBA secondary? What were people whispering about in the halls? And so you heard Pulte speak then, yes?
I
No?
didn't. I
Okay.
didn't. I read an article about what he
Oh,
said.
got it.
I
Okay.
missed his session. I talked to people afterwards. I actually came a little bit late. Um, but kind of as I mentioned before, the kind of spirit of everything, the vibe of everything was not as kind of in the doldrums as it's been, and it wasn't as just wait, just you wait, here it's coming. It was neither of those things. It was very, here's where we are. You've got something new, something about non-QM. I'm interested in hearing that now. Or what are some of your ideas? Have you heard about this? That's why I brought up that loan sense. I had a lender customer of mine ask me about something he'd heard about years ago, and now he's thinking, that might be something worth something to my borrowers right now,
Yeah.
where, I think they have been waiting for something to come along, waiting for the rates to drop, waiting. And I think that a lot of us have been guilty of that, of waiting for something to change rather than do it yourself and admit to where we are. So I did get that sense of that is where a lot of lenders are right now, is kind of like, yeah, acceptance. Here's where we are. And
Yeah.
now I need to kind of look at things, and so I think there were a little bit more meetings than usual,
Mhm.
with people talking, or introductions between people of what uh, could be of interest of them. And I think it's interesting, Tony, what it's saying about changing. We can't help ourselves in this industry too, where I think it's like we're waiting for a shiny object to kind of dingle dangle in front of us, to jump to it, to make it better and to get faster, or to do this over here. And I do think there's something to be said about just sitting in this for a little bit and looking at those things, and like what is truly needed and what is something that we can be a solid, um, you know, company that is making positive change without having to do these 10,000 crazy things. It's getting down to knowing the different programs. How can we offer? How can we not turn away borrowers and bring them in and educate and all of those things, versus finding some thing over here that can whiz wing boom and do it for them or not. I think it could be an exciting time, even though it seems kind of like,
Okay. I know that this could be just me, but I think it's always exciting. It is.
yeah,
I mean, sometimes it's scary as hell, but a lot of times it's exciting. Mostly it's exciting because it's always changing, that's for sure. But again, when you're hearing somebody say, "Oh, and we're so excited because this piece of technology is going to read your purchase contract." Well,
right,
okay, purchase contracts tracks are boilerplate plate. You have a whole bunch of pages of blah 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 that's standard that you don't need to read because it's always standard. And you know where to go on that purchase contract to look for the details of the transaction, which as an LO, I need to do that anyway. So, okay, maybe the computer can read it and I'm not clear exactly on what the value of that. But my question is, how much does it cost to train that system to do that? How much
right.
does it cost to deploy that technology into the industry? And we're so excited because now we don't have to read a contract. You still do, because the regulators, when they come in to audit you and your borrowers, by the way, they expect you to know what is happening in the transaction.
Yep.
And if they're going to nail someone, they're not going to take your AI system to task. Your tail is on the line. So again, we can't offshore all this stuff. I mean, we have to know it ourselves. And so I just think that we are doing, and I keep saying this, and at some point maybe I'll stop. We'll see. We just have got to not try to be so. Don't be lazy. You know,
Yeah.
I mean, granted, I don't love grinding through paperwork eating either. That's why like you have assistants and they can help you with inputting things or whatever. And maybe, I mean, we had a system where it was reading all the income documentation, but it all had to be double checked by a human, and I think they abandoned that, at least for now. So it'll be interesting. I love technology, but not when you have so much of it that you couldn't possibly stay on top of it. You go into a meeting, they throw all these different things at you. You don't have a clue what any of them really do, and you sure as hell don't have time to learn all of them. And so it's just tricky. It's just, I mean,
Yeah.
I think the balance now is way better than it was, say, 4 or 5 years ago, where every single widget that came up, everyone had to have it, right? But the
Yeah.
reality is they paid for all this stuff and then they didn't use a lot of it. So
Yep. I
again,
think that it goes back to the variable control, right? It's that I think that it is important for us to stay on top of what is changing. I mean, especially with AI, we need to know how this is going to benefit us and how we do things. But I
yes,
do think that the focus has to stay on also what can we control in this moment?
yeah,
What can we control on a day-to-day basis? And I think for you, what you said of staying curious, making sure you know what's out there, what's available, versus waiting on things that are a question mark.
right,
Where can we find the value on a day-to-day basis? And that curiosity could be a loan program, it could be an actual technology piece that we haven't used before that is does it really make sense? What's the ROI? How are we going to implement that? I think it's really that curiosity piece is really, really important, but how you do it versus like hope versus the right now, I
yes.
think is equally.
Well, and I think that I would just like to challenge everyone, learn something new this week that you
Yeah.
can use in your business. Learn one new thing. Start there. And or just take anything. I mean, I throw these things out there all the time. And by the way, I'm looking at the chat and I hate it. The last thing that it says is blame it on Audrey, which I think he was joking. We'll see. Probably not. But anyway, I'm like, I keep seeing that and I'm like, ugh. Anyway, we have nothing but opportunity right now. We really do. Just absolutely make sure that you are engaging as a professional and not just trying to dial it in and there you go. Okay, thank you, William. He goes, great conversation today. Thank you. So
Mhm.
much better. I'd rather end with that than, oh God, here we go.
Wah, wah.
Anyway, yeah, so there is always something new to learn, and it is so fun to embrace something that you can take to a borrower and also don't be afraid. This is the most important thing. Some people think they have to know it all, right?
Oh yeah.
Oh, I'm the expert. I know everything. I do this all the time. I'm like, let me double check on that. And I tell them the industry changes endlessly. I want to make sure that is still the rule. Don't be afraid to do that. Don't be afraid to just say, I'm going to get back to you. It doesn't make you look stupid. It makes you look smart to make sure
Yep.
that you're right about it. So, on that bright note, the challenge is go learn something new this week. One thing, that's all I'm asking, and then report back next week. And Tracey, we love you. And thank you so much for being here. I cannot
Thank you, Audrey. Appreciate being here always.
Ah, God. All right, kids. Have
All
a
right.
wonderful week. I'll talk to you later. Bye.
Bye. Thanks, everybody.